Hi, welcome to my channel. I am back. It's been a while. I'll make a video going over that. But today we're gonna be reacting to this reventure app guy. This person that I actually watch, and something that I disagree with him because he doesn't understand the underwriting process. You know why? I do. I've been a loan underwriter for over 10 years for mortgages, for a little bit over 5. So I understand the process that it takes to approve somebody for a mortgage, and especially an FHA. So there's a lot that I disagree in, be able to add better context to what he's saying, and then hopefully educate him. If you see him, refer to him to go ahead and watch my video. I'll definitely like to go ahead and have a Discord with him, and be able to go a little bit more through with the information that he's talking about. So let's go ahead and hop into this video. So let's check it out.
Low down payment mortgages, and a lot of them are now going into default. And so I think we could see lower prices here in Fort Worth. We could see lower prices in a city like Las Vegas. We could see lower prices in Orlando. Those are some of the top markets for FHA mortgages in America, and would be some of the ones that are most exposed if these foreclosures are set loose, and if the Trump administration does the right thing and turns off this subprime mortgage support offered by the U.S. government. And I think some people in the real estate industry watching this might take issue with me calling these subprime loans. They're going to say, no, Nick, these loans have income documented. They're nothing like the mortgages from the mid-2000s. But the crazy thing, everyone, is that when you look at the credit quality of these mortgages, they're horrible. They're worse than they were in the mid-2000s. The Wall Street Journal has a graph showing the percentage of FHA borrowers who have a debt-to-income ratio above 43%. It's over two-thirds. Over two-thirds of FHA borrowers, when they get the mortgage, have to pay over 43% of their income to debt costs. I want you to think about that. That means pretty much anyone borrowing from the FHA program right now is doing so in a situation where they can't really afford the payments. Back actually in the 90s and 2000s, it was only a quarter of all FHA mortgages had a debt to income above 43%. And some of the stuff that was happening here, folks, was absolutely wild.
All right, let's touch bases on that. So he says that essentially that a lot of the credit quality um is bad within FHA, which is what I don't disagree with that, because again, what was FHA designed for? FHA was designed to go ahead and help the middle class to be able to get affordable homes, or I guess ones in case, for them to go ahead and get financing for a home. So people that don't have the best credit, that's why the FHA was there for. So what this tends to fall back on is more about the lender, and I can see how it plays a part, but it's not a direct cause of what he's overall explaining. Yes, people do have credit problems and they're still able to get a mortgage, but FHA has made it and put it on the lender, that the lender needs to go ahead and be determining if the credit history is sufficient in order for it to be sent to FHA, right? So here's an example of what I'm talking about. And again, I know this information because again, I got peoples that send me information, so I'm able to get the inside knowledge of what they look for when it comes to approving these loans. And again, I've been doing this for 5 years, approving mortgages, so I understand the process myself. All right, so when you are getting a mortgage, this is pretty much the requirement for FHA. You have evaluating credit history section, which goes off. So when someone does end up having any of these things, what has to go ahead and happen is they have to have reestablished credit within the last 12 months. That's how FHA accounts for positive credit. So if you've had collections, missed payments, throughout the course of your credit. As long as it's been over a year, they'll consider that you reestablished your credit, which I think is great because, again, it comes back to the whole premise. What was FHA for? To help people get homes in the middle class, because we're um, having a problem with wealth inequality, of how the rich just keep getting richer and the poor keep getting more poor. And I resonate with this because I'm definitely in the middle class. Even though I make more money than what I did before, I've been struggling to try to get into a home that won't cost me an arm and a leg to go ahead and get in. So it's like you're in the stuck. I am in the place between, well, do I get a condo? But then you have the HOA fee that tends to be very crazy when it comes to condos, because again, condos do tend to be more affordable than actually getting a home. Well, let's see, if I want to get into being a real estate investment, which is what I would love to go ahead and do, and get a 4 unit home. Well, with those, they're a lot more expensive, and you have to have more of a down payment for them. It has to be 3.5%. Well, on top of that, you gotta also have up to 3 months of reserves on for the mortgages, and then you have to pay PMI on top of that, which is what helps protect the loan, which is the whole reason why you pay into it. So there's already these barriers in place to be able to go ahead and protect. But again, FHA places it back um, on the lender for them to go ahead and do it. Um, so going back on over here, so how's referring to and talking about how it falls back on them. So in this section through FHA, it states the mortgage must determine that the borrower exhibits satisfactory credit prior to the onset of the economical event. So if they ended up having some type of event that went ahead and caused them to be it, as you can see, as clear as day, they have to show that they have reestablished. So that's the thing that he doesn't seem to understand. The whole premise of what FHA was based on was to help people get into homes that are more challenged credit, which I've been able to help tons of people. What it comes down to is the lenders. There are things called lender overlays. So pretty much right here, this right here is the rule. So if you want to be able to sell the loan to FHA, which is essentially what happens in the mortgage process, you have to be able to conform to these rules. This is their rules, so you have to abide by it if you want them to buy it from the financial institution. So then lenders will make additional rules on top of that. That's essentially what an overlay is. It's just a rules on top of rules. So essentially, here is one from a company that I was actually able to go ahead and receive. Give me one moment. All right. All right. So as you can see, here's one through a lender. Here it is. So he's talking about how they don't have a great credit quality. So here's a rule on top of FHA. So this one talks about collections. So if the credit report shows a outstanding balance more than 2,000, either the lender has to go ahead and make sure that the debt is paid prior to the loan closing. Make sure to go ahead and just debt load it onto their debt to income 5%. If it's medical collection, doesn't matter, etc., etc. So here's that is one instance of a rule. Here is another one. The FICO score must meet the minimum, at least one of them. So with them, I think with them is 640 they have to. Also, he explained and said it went back down to 580. But essentially, as you can see here, it is up to the lender of how they do it. So you can't put the blame On FHA, you just can't, because again, they tell you, hey, it's up to the lender. So if the lender's doing it wrong, it's definitely more on their end. But let's go ahead and hop back into this video and continue going over this here with him.
You go further into this Wall Street Journal article, they mention how in 2024, mortgage servicers made 552,000 incentive payments to mortgage borrowers to prevent them from getting foreclosed on. Translation, mortgage servicers took money from the U.S. government FHA mortgage program and put it in the pockets of defaulted home owners under the FHA mortgage program who could not make their payments. That is absolutely absurd. What's even more absurd is that in some cases, the government is automatically lowering the mortgage payments for these defaulted borrowers by 25%. If you go to the FHA mortgage website, it says very plainly, if you're in default and claim financial hardship, you could have your payments reduced by 25% with no contact. They could just do it automatically. And I sincerely hope that Scott Turner, the new head of the FHA, sworn in under the Trump administration a couple weeks ago, takes a serious look at what's going on in his department. And so, folks, get this. There's 7.8 million FHA mortgages outstanding. That's approximately 17% of all mortgages. So there's 54 million mortgages total. 13% are already in default. And actually, 17% of the mortgages originated in 2022 are in default. So, think about that. 17% of these mortgages originated less than 3 years ago are already in default. The borrower's not making payments. And so if you are curious why home prices haven't dropped by more, why this housing market seemingly still makes no sense in most parts of the country, the buyer demand's way down, the inventory's way up, but the prices haven't really come down in most areas, well, this is one of the reasons. Your government was actively conspiring to prevent the needed inventory from coming to the market. Excuse me.
And this is what I mean. He's saying the reason why it did not go ahead and lower more is because of these defaults, which again, that I think it plays a role. I'm not gonna sit here and say it doesn't, but what this idiot is missing is that, so during the pandemic, when I was underwriting loans, what I would see come across, and I imagine you know a person that may have did this, what they would do is either they would sign a document stating that they're not going to go ahead and use an appraisal. So they were taking the prices based off the seller because it was a seller's market. The sellers could just say, I'm selling this house for 500,000 even though it's valued at 300,000. And what happens is that the lender would just take it because that's one indicator of determining a value of appraisal, what the prices is, which is something that I will go into a little bit more deeper. But that's where the mistake I say came from the lenders. But the problem that you also have to look at it from the lender's perspective is, if you don't give them a loan, if you don't give them that loan, the mortgage company or the finance company down the street will. So I think that definitely came into a lot of strong factors when it came to giving these inflated price, no appraisal mortgages, is that essentially they didn't want to miss out on the money. So this is when it comes back to greed and capitalists. And this is what happens when you take it to the extreme. So I think that played a bubble. The lenders, the way that they handled how to go ahead and do, because I was like, this is just a temporary thing that's going to happen. I was like, homes aren't going to continue increasing year after year. Granted, it has, but it gets to a point that it's at a bubble that it has to go ahead and come down. So that is one thing. The second thing is, I blame the appraisals. If I had to give most of the blame, I would blame the appraisal association for not cracking down on this, because that is one metric that is very important to the value, is, which I don't like, is how much would this person pay for a house, or how much or exactly. So what happens is, so when there's a house that gets sold, right, and then the appraisal is going to go ahead and do a value around the neighborhood, they look to see what price the other house is selling at, which I think should be taken into consideration, but should not hold as strong of a weight due to the economical or to the housing condition. Because obviously during the pandemic and the years that came after, it was just a frenzy. It was abnormal. It was an anomaly situation that happened. So I think the appraisers should have took more responsibility when they did do appraisals to go ahead and make a better evaluation of determining the value of the house. Maybe looking into what, only because the house down the street got remodeled and it's newer, or maybe a new house was built, doesn't mean you're going to go ahead and give a crappier house a better value on the home just because that home sold for more. That doesn't make sense. That's the thing I don't like about determining value for homes, is that it's weighted on location instead of the actual house, because you are living on the land, but you're not. Your room is not on the land. Like if you remove the structure of the building, you're just gonna sleep in a you're just gonna sleep in a sleeping bag on the land. So I think it needs to be changed to determining the value of the actual house. You know, what year was it built in? Okay, has it been remodeled? When was the last time it was remodeled? When was the last time any foundational upgrades have been done, like roofing, maybe fixing the foundation, replumbing, all that stuff? That stuff is what really should matter, because the thing is, you're gonna live in the property. You want to make sure that it's functioning for your purpose and needs. So that's where I really think is really the downfall, is the mortgage lenders and the appraisers. The mortgage lenders for allowing to accept documentation of not wanting to do the the appraisal on the home, and then the appraisers association failing to regulate on this anomaly, this one time uh, this one time event uh, that's influencing the prices of the homes to go ahead and continue to increase, which is the whole point that I think this person is missing, is that he's not seeing outside of, oh, it's just not the FHA. He's he's trying to make it seem more bigger than usual, which again, to me, it's like, when it comes to these things, like being in the middle class, we need to have programs like this to be able to become more financially wealthy. Because again, as you can see, the in the supermarkets, when you go to buy stuff, us in the middle class are seeing that we're being squeezed by greed while the companies continue to make profit, right? So then it's like, well, we need some a lot we need a lot more benefits than the people that are upper middle class or people that are rich, that are millionaires, because they're already getting all the benefits. Again, they get the best tax write-offs. They don't have to worry about inflation because they make a certain amount of money. And then again, I might get people in the comment section, well, tell them to find something that makes them more money, educate themselves. Yes, I that is obviously a given, right? But even if you do that, it takes time for that to do. It's like it's a domino effect. So because the government does not decide to give us better education, financial education, it becomes this miseducation where then we don't know, as people in the middle class, how to go ahead and make money. It's really through networking and getting to know people, and then learning also through YouTube, which I think YouTube was a great thing that was created, because you get to learn instead of it all the information now being isolated or needing or being blocked by another person, right? It's like gatekeeping essentially. Now the information is out there for you to know. So it's like that plays also a role, because obviously if you're not financially educated, from the, you know, after you finish high school, it's going to make it really hard for you to be able to know how to make money, how to go ahead and retire, how to manage your finances and your credit. You know, that all plays a factor as you grow. And then obviously if you have a domino effect that each each parent generation, it changes, that your parents don't know it, their kids don't know it, and then their kids don't know it. Like, of course, people are gonna have challenges with their credit. It's obvious, which this guy's trying to paint it in a bad light. But let's go ahead and continue, because there's still a lot more to go ahead and explore, and I'll go ahead and continue on ranting, I guess I'll say.
350. You can see here in Dallas, data on RevenTrap is showing that home prices are actually flat year over year across the metro, but are going down in most zip codes. So most zip codes in Dallas are experiencing declining prices. And in general, it's the lower income areas where the prices are dropping, the areas with more FHA mortgage borrowers, the areas where the investors are selling, that's where the prices are dropping, while the higher income areas still have prices going up. And you can actually see here, folks, we have another house here for sale. Now, this is from Starlight Homes. Now, this is a 3-bed, 2-bath, 1,600 square feet on the market for $321,000. Still sitting here on the market. You can tell they got a lot more homes in inventory. And if you're wondering why the prices are dropping and why that seller over there had to cut from 320 to 280, it's because of the builder, right? So the builder over here is pricing a new home at 320, built in 2025. Well, if you bought the old version of that home in 2023, you can't sell it for 320. You got to drop the price. And so this is yet another example of these builders being very aggressive, delivering inventory onto the housing market. I showed you this in Florida over and over again. It's also happening here in Texas. And these builders, everyone, they got over 120,000 completed spec homes on the market right now. That's the highest level since August 2009. So think about this. We got the highest level of builder supply since the last crash. We have the highest level of FHA mortgage delinquencies since the last crash. Things are starting to really add up and show that the housing market is in a downturn here in 2025. Interestingly, we got a house here that's for rent. So this is another new build. It looks like the builder sold this to an investor. On Zillow, it says the investor is Brandywine Homes out of Atlanta. It was listed for $334, pulled from the market. Sometimes these investors will buy from the builders at a discount in bulk in an off-market deal. Well, they have it listed for rent at $2,200 a month. And the issue with that, everyone, the $2,200 a month rent, you can let me know whether you think that's fair, is the fact that if you were to buy this house...
Of course not. It's not fair. Of course that isn't fair. 2,200. Who's really making 2,200 without having them to have potentially another job that's in the middle class? Like, for me, that would be a whole paycheck of mine. That would be a whole paycheck. And remember, that's before even utilities, Wi-Fi, and gas and heating. Like, it's all before that. So it's like, why would I want to go ahead and pay a whole check to live in a home? That makes, to me, that doesn't make any sense, especially if it's being rented. But let's get back to the video.
Which this investor did, and you were to pay the taxes and insurance and all that, it's going to be around $2,200 a month. You're actually not going to make any profit as an investor buying in these home building communities in Texas. With where mortgage rates are, with where property taxes are, your monthly payments are going to equal or even be higher than the rental rate that you can get. And these elevated mortgage payments in Texas are a big issue, right? Texas was always a state that was affordable, but it's no longer affordable for many borrowers. And it's the mortgage rates and the sky-high property taxes that are doing that. The average property tax rate in Texas is around 1.5 5%. Here in Dallas, Fort Worth, it's even higher than that, meaning that if you buy a house for 500 grand in Dallas, Fort Worth Metro, your property tax bill is probably going to be 8 or 9,000 a year. At least it could even be above 10,000 a year. But back to this subprime issue, everyone, because there's just so many golden nuggets in this Wall Street Journal article. I really encourage you guys to read it. They did some great reporting here, but it's just showing how messed up this whole program is. Again, it was done under the Biden administration. They basically took what these was supposed to be short-term pandemic mortgage relief, and they just extended it all the way to 2025. And their idea was to extend it indefinitely into the future so no one could ever be foreclosed on again. But the reason they were doing this was not out of the goodness of their hearts. They're not actually trying to protect the homeowners. They're simply trying to stop the inevitable flow of inventory from hitting the market and home prices going down. Because it would actually have been way better for these homeowners under the FHA mortgages who are in default. Again, it's 1 million in default, around 400,000 seriously delinquent. It would have been way better for someone who bought in one of these building communities in Texas in 2022 who went in default in 2023 to just sell their house in 2023. Instead, these government programs lowered their monthly payment, gave them incentive payments to stay in the house, and in many cases tacked on the missed interest to the mortgage amount. Meaning that if this borrower who was in default and didn't make the payments wants to go sell in the future, they're probably underwater. The Wall Street Journal article gave an example that if someone missed 5 payments of $4,000 a month, that'd be $20,000. In many cases, that $20,000 would be tacked onto the mortgage to be paid at payoff. But we all know in many cases that's never going to be paid, and the taxpayer is going to be on the hook for it. And this is something that should be in the crosshairs of Doge. This is one of the prime examples. And if Elon is serious about this, he's got to go into the FHA, stop this crazy program of mortgage forbearance, loss mitigation, paying borrowers so they don't get foreclosed on. I mean, how insane is that? What are we coming to as a country that our government is now doing that? Elon, you really gotta stop this from happening. Scott Turner, head of the FHA, you got to stop this from happening. If anyone from the Trump administration is watching, this has got to be one of your foremost policy focuses, because we have to return fairness to the U.S. housing market. People who accept a low down payment mortgage and don't make their payment, sorry. You should get foreclosed on, and someone else should have the opportunity to buy the house. In addition, we should probably look at the loan program overall. Why are we giving borrowers 43%, 50% debt to income mortgages at 3% down? That makes absolutely no sense. And in terms of brass tacks, what this means for you as a home buyer in 2025, so I want to kind of bring this all together for you.
All right, let me bring this all together for you. So the award for the biggest clown goes to him. What happened to compassion? I think I get what he's saying. Obviously, if you can't afford it, don't get it. But what happens is, so I'll break this down from a mortgage underwriter's perspective. So when it comes to a mortgage underwriting, we're verifying the down payment. If it's more than a 1-unit home, what will happen is then that we need to get additional money for reserves. The thing that I don't like about the reserves is that it's not held and kept for an actual rainy day, because that's essentially what a reserve is. So let's say if you have a house that's your mortgage payment is $2,000 a month, they'll require for you to have 2 months, 1 to 3 months of the mortgage payment saved. That's essentially what a reserve is for the people that don't know, right? So essentially they'll have you have that whenever it's a house that's more of 1 unit. So think of a duplex, a triplex, or a fourplex. So like a 2-unit, 3-unit, 4-unit, right? So so that's what happens after that. Depending on their credit, there are LTV restrictions. So if you are at the bottom end of the 580, your minimum down payment isn't 3.5%. It is more closer to 10% when it comes to a down payment, because again, you're a lot higher risk. And then again, it also comes down to also if you have compensating factors. So he's talking about the credit problems. So if there's someone that has credit issues, like maybe a couple of years ago they let some loans go bad, but then in the last 12 in the last year they're able to recover their credit and repay their loans on time. But we see they have 6 months of a rainy day fund on a loan to prep for this mortgage. Why would we decline him? And then maybe, let's say, if he is maybe putting 10% down or 5% down, that's a huge that's a huge commitment from somebody. Why we would want to turn that person down because they had a credit event that happened a couple years ago. You see how he doesn't understand the process in and that's what bothers me from his personality, which comes back to also being compassionate. He doesn't understand being compassionate because, again, he's at a certain level of income, and if I'm pretty sure he's aware because this is the finance channel, right? I'm aware he's aware of that there's been massive layoffs. So what happens when massive layoffs happen? People tend to not really have money saved, as the government has has reported, and like people are going into credit card debt. Um, not just because of the layoffs, but when you do get laid off, that will happen. That happened to me. I dipped a little bit more into my credit cards because I didn't have a rainy day fund. So it was like I get the compassion, and imagine having to kick someone out when you have the ability to maybe help them. That's the thing. That's what happens when you get to a certain level of having money. I'm not going to say wealth, but having money, you lose compassion towards the people on the bottom. You make it seem like they just wanted to stop paying. Life events happening. Family member dies, someone gets into an accident, someone loses a job, which is now common nowadays. There's so many things that can happen that the reason why they get so behind, right? And that's the thing that he's missing, and he's trying to shift it and get the program removed. I'm like, no, you can't take away this program that helps middle class be able to afford a home. I think what needs to go ahead and happen, which I'll, depending on what he says next, I'll tie that in of what I think needs to happen in order, because again, I do agree with him. He's just being so damn extreme for no damn reason. Because I'm like, no, I was like, why? I was like, to me, this also resonates with me because I've been trying to get a home um myself, but it has been very challenging to go ahead and be able to do that. A lot of people can relate to that. So I'm like, why would you get rid of why are you cheering or recommending for Doge to go ahead and get rid of this when people like me need it? I was like, it's hard enough to get into a home and try to afford a house. There was a house, not a house, it was a condo that I was looking into that cost $89,000. Or not 89,000, sorry, 132,000, because I wanted to get into like a 2 or 4 unit home, to be able to start building a retirement fund based off that as an avenue, because I'll have like two to three different avenues of income coming in outside of social security, right? So I was trying to look at it. I saw that the mortgage payment was just going to be really high. So I was just like, you know what? Let me just get something because I need a place to live in general. So let me go ahead and just find just a house to have for the moment. I don't need to live there for a very long time and just get it, and that's it, right? It's a place that I have to live. I can move once I save out to get the investment property. After factoring in the mortgage payment, PMI, which is private mortgage insurance, whenever you don't put 20% down, insurances, which has been home insurance, which has been going through the roof, and then increasing taxes because again, the government's being greedy about the housing prices, right? So charging people a lot more property taxes. Um, um, the payment for a $135,000 house came out to like $2,000. I'm like, with the interest rate being around like 7.5%, I think is what I did. And I'm just like, that's insane for that house. $2,000, And again, this is not including electricity, heat, Wi-Fi, water bill. So it's like, yeah, it's frustrating to be able to find a house to be able to afford that's not gonna break the bank. Because also there's retirement that still needs to be saved, and then there's a rainy day fund in case if something else happens in life, I have money to save. So it makes it really difficult to be able to do it without these programs. Because if it wasn't for this traditional mortgage credit, they credit credit drives most of it. So if you have like a 720 credit score and up, you're fine when it comes to getting a Fannie or Freddie mortgage through a traditional mortgage sense, because they're really credit score driven. FHA is more for people that are challenged. Again, that was the whole reason it's created, and this idiot just doesn't seem to get it. He's thinking from his perspective as an investor. As from a business perspective, it makes sense. It's not that it doesn't make sense. It's just he's trying to shut down something for what most of us people can benefit because of a few bad apples. Because again, this isn't everyone that has a FHA, right? It's not the whole loan portfolio that is past due. It's just a certain amount of people, maybe the majority. I haven't looked into the numbers that it is. So what that does is that puts it back on the lender. Why did the lenders approve what they did? What were the compensating factors? If the debt to income ratios is above 43% of what he's talking about. So that's the thing that I just dislike this video so much about, is that there isn't any compassion, and he doesn't have an understanding of the insight of what it takes to approve a mortgage of all the, or at least he should be able to have some understanding, if, because I assume he must have a mortgage. So, and if he does have investment properties, he understands that process is like, hey, we need to be able to see that rainy day fund. You have to have this certain LTV. Your credit score has to be at this much. Your down payment has to be at this much. We got to see proof of the earnest money deposit you did for the purchase of the property to get the contract, etc. So it's like, I think you should be familiar. So it's very odd that this clown is not seeing it from that perspective, because that's what I saw. I literally saw that. That I'm just like, well, if you look at how the economy is going for middle class, it's not going great for us. People are being laid off left and freaking right. It's not funny. Like, it took me over a year to be able to find the high paying job that I was able to go ahead and find after losing one. And I'm very grateful that I was able to do it, because I didn't know how long it was going to go ahead and be before I found another job, getting paid to do underwriting at a high amount. So I was very grateful to be able to get this opportunity. So like, so I feel for the people that are going through this hardship. Are there a couple of frauds? Yes, because not everybody's 100% a saint, right? But the majority of the people, I believe, are very good people. So for this person not to recognize this is very disappointing on my end, because I was like, don't sit here and advocate to lose a program that can benefit the majority because the minority is is messing with the program, right? But let's go ahead and finish up and see what he says, and we'll get back to this video.
Now, if you're a potential home buyer or a seller, what does this subprime loan program, its existence and potential ending of it maybe in 2025, mean for you as a buyer or seller? Well, it means that there's a lot of volatility and insecurity in the market, particularly in neighborhoods with higher FHA mortgage concentrations and metros with higher FHA mortgage concentrations. It tends to be Sunbelt markets in neighborhoods with lower incomes where we see the most FHA mortgages. So if these defaults inevitably turn into foreclosures, it's going to drive down home values in the areas in blue on this map in DFW. These are the areas with the lower incomes. I think these are going to be some of the areas most affected. Again, in terms of metros, it's going to be Vegas, it's going to be Phoenix, it's going to be Riverside, California, it's going to be Houston. It's going to probably be a place like New Orleans. It's going to be a place like Birmingham, Alabama. Definitely a place like Atlanta on the south side. If you got
Sum up my rant. Pretty much, I went over the mortgage process, mortgage underwriting process of how we look at compensating factors, we look at rainy day funds, we look at loan to value to be able to compensate for bad credit, which is what could have happened at this point. Because again, there's a lot of situations that could have happened. These people could have had this money, but needed to be spent because maybe they lost a job, so now they got to pay their bills and rising costs. Those are like the very common ones. So so that's what I was able to go ahead and show you, and also expose his level of compassionate that he does not have. Because again, this is coming from a person that makes a lot more money than the middle class. Like this guy, he easy maybe makes over $150,000 a year, taking a good guess, based off his subscriber count, and he has an app. So I was like, so look at that. Another person that's making a lot of money trying to advocate to close out a program that will help the middle class and help the middle class and more challenged credits, just so him and others like him can go ahead and buy up all the properties that they need. Again, I'm not against capitalism or wanting to make money, but when it's pushed to the extreme level, this is an extreme level. He wants to get rid of a program that helps benefit majority of the middle class. And that's where I have a effing problem. Like the reason why I don't curse is because it's YouTube, so you know how that goes. But anyway, um, yeah, because I'm every bone in my body's. It's hard not to want to go ahead and react, and just curse, um, because yeah, I was like, it's becoming a lot harder to be able to get into a home. It's not going to become easy. So I'm hoping these don't default. Based off what he showed, it will at some point if it doesn't get managed. But I'm hoping that with Scott Turner, he looks at putting a fee against the lenders that want to send these challenged loans. So when it comes to auto loans, so here's kind of a little nugget, a little education. So when you go to finance through the dealership for a car, they send it to lenders that then they have an agreement if there's like a first payment default or something of that nature, that pretty much they're not making their payments on time in the first couple of months. The dealer will have to pay back the finance company, the lender, right? I think the same thing should be with these lenders, because again, the lenders decided to put profits over quality. This is the whole thing, quality over quantity. So because they wanted so much, since they wanted money, they were so taken by the greed, because again, the loans are not coming in because interest rate is just high. People can't afford these mortgages, so obviously that's going to play a huge factor of why people aren't applying for mortgages. Duh, right? So it's like they decided to do this and make exceptions, and then I guarantee I wouldn't be surprised if there's been underwriters that have been persuaded to make decisions that they didn't want to. I know I've seen it in the industry. It could never be me. I'm like, whatever. I was like, put me on disciplinary action. I was like, I'm not doing it. I was like, I'm not. I was like, I'm a person, when I approve somebody, I I try to make sure that I have a great balance of credit quality, but also meeting the members' needs and helping them accomplish their their loan or their financial goal. That's the whole reason why I became an underwriter, is to be able to be an impact towards people's lives, to be able to financially help them with their goals. That's a way that I can give back to the community, is what I like to go ahead and say. So so for me, like, I will look for compensating factors if it will go ahead and help if everything else is in line. So this guy, again, a clown. Send this to him. I want to smoke with him. Reventure Consulting. I would like to jump on this call and get into a little bit more of the details and We can see if we can come to a middle ground, maybe. All right. Well, if you're new to the channel, welcome. This is your introductory to me. I have tons of content for you guys to watch. If you are a subscriber, thank you again for watching. And just stay tuned for some more. And share if you liked. And then follow me on the other social medias. All right.